In 2009, the corporate world was rocked by one of India's most notorious scandals, involving Satyam Computer Services Limited. Once hailed as a beacon of success in the IT industry, Satyam's flawless facade crumbled, revealing a shocking tale of deceit and financial manipulation. This is the story of how a company's meteoric rise turned into one of the biggest corporate scandals in India's history. Ramalinga Raju and Ramalinga Raju, the two brothers, started Satyam Computer Services Limited in Hyderabad in 1987. The name signified truth in Sanskrit, an ancient Indian language. At the outset, the company employed 20 people to provide BPO and IT services to a range of industries. Due to the company's early success, it was listed and decided to go public in 1991 on the BSE. Following this, Deere & Co. became the company's first Fortune 500 client. This made it possible for the company to expand even faster and get to the top of the industry. After TCS, Wipro, and Infosys, Satyam quickly rose to the position of fourth largest exporter of IT software in the sector. At the height of its popularity, Satyam operated in more than 60 countries and employed over 50,000 people. At this point, Satyam was regarded as the quintessential Indian success story. Its finances were flawless as well. In 2003, the firm's valuation was $1 billion. In 2008, Satyam quickly surpassed the $2 billion milestone. The business saw a 40% compound annual growth rate, an average operational profit of 21%, and a 300% rise in stock price throughout this time. Now, Satyam serves as a model for other businesses as well. In 2008, MZ Consult bestowed upon it several distinctions, including the prestigious Golden Peacock Award for Corporate Accountability, in recognition of its leadership in Indian corporate governance and accountability. Because of his commercial skills, Mr. Raju was also well regarded in the industry and received the 2008 Earnest and Young Entrepreneur of the Year award. The Satyam board chose at the end of 2008 to acquire Mr. Raju's real estate business, Midas. The decision was overturned in 12 hours as a result of the shareholders' displeasure, which had an effect on the stock price. The World Bank prohibited Satyam from conducting business with any of the bank's direct contacts for a period of 8 years on December 23. This was one of the harshest sanctions the World Bank had ever placed on an outsourcing business based in India. The World Bank had claimed that Satyam improperly benefited bank employees and had neglected to keep records supporting the fees it invoiced its subcontractors. But were these claims accurate? Satyam was the diamond in India's crown at this time. In a response sent just 2 days later, Satyam asked that the whole World Bank apologize and provide an explanation for its conduct, which had undermined Satyam's investor trust. Satyam scam case study. What was behind the curtains? While investors were still coming to terms with the collapsed attempt to acquire Midas and the World Bank's accusations on January 7, 2009, Mr. Raju resigned and admitted to manipulating accounts totaling 7,000 crore rupees. Globally, clients and investors were taken aback. There is no way this could be true. Well, we would have to go back to 1999 to comprehend the hoax. To satisfy the expectations of the analysts, Mr. Raju had started to inflate the quarterly earnings. The numbers that were released on October 17, 2009, for instance, exaggerated quarterly earnings by 97% and revenues by 75%. Along with the company's worldwide head of internal audit, Raju had completed this. Mr. Raju created many bank statements on his desktop computer to artificially inflate the balance sheet with funds that did not exist. To increase revenue, the company's worldwide head of internal audit produced fictitious invoices and client names. The firm would then have easy access to financing as a result, and the perception of its success would raise the share price. Furthermore, the money that the business had raised from US markets was never even recorded on the financial sheets. Raju, however, did not find this enough, and he continued by making records for fictitious workers and collecting their pay on their behalf. Raju was motivated by the rising share price to sell as much of his shares as he could while still holding enough to be an owner in the business. Raju was able to benefit from their sales at a premium price as a result. Additionally, he took $3 million each month as salary on behalf of non-existent employees. However, where did all of this cash go? Raju had built a fantastic IT firm, which he had a real estate stake as well. Hyderabad's real estate market was flourishing in the early 2000s. There were also rumors that Raju was aware of the layout or route for the Hyderabad Metro project. In 2003, the groundwork for the metro plans was established. Raju quickly invested all of the funds in real estate in the expectation of turning a healthy profit as soon as the metro was operational. He also founded Midas, a real estate firm. Regrettably, the real estate industry was severely impacted by the 2008 crisis, just like every other industry. By then, the significantly exaggerated assets and underreported liabilities were the result of nearly 10 years of financial statement fraud. The books revealed that there was about $1.04 billion in cash and bank loans that were non-existent. It was just impossible to bridge the distance. Whistleblowing attempts were also beginning to emerge by this point. Director of the company, Krishna Palipu, got emails under the pseudonym Joseph Abraham. The deception was revealed via the mail. Palipu sent it on to another director and their auditor, S. Gopal Krishnan, a partner at PwC. Palipu received assurances from Gopal Krishnan that there were no lies in the message and that on December 29th, a presentation will be made before the audit committee to reassure him. Later, the date was changed to January 10, 2009. Raju still had one final option. This strategy called for Satyam to assume control of Midas in order to close the distance that had grown over time. The purchase of Midas would be justified by the updated financial statements, but shareholder resistance contributed to the failure of this strategy. Raju felt forced to do this, exposing himself to the judicial system. It was like riding a tiger and not knowing how to get off without being devoured, Raju later said. Satyam scam case study. How did Raju manage to get away with the scandal? When investigating this massive scandal, the next crucial question to ask is how Ramalinga Raju, who worked for a corporation with over 50,000 employees, was able to get away with the Satyam fraud, Satyam Computer's fraud. The awful performance of PricewaterhouseCoopers PwC, their auditor, is the cause of this. PwC was the company's external auditor, and it was their responsibility to check the accuracy of the financial records by looking through them. It's astonishing that after nearly 9 years of Satyam audits, they failed to discover 7,561 bogus bills. The auditors may have identified several warning signs. First of all, a straightforward bank check would have shown that the cash amounts were inflated and the invoices were invalid. Second, any business with Satyam's level of cash reserves would at the very least put those funds into an account that paid interest. However, this was not the situation. Even with these clear indicators, PwC appeared to be ignoring them. When it was later discovered that PwC had received double the amount charged for their services, suspicions were raised. PwC was unable to uncover the scam for nearly 9 years, while Merrill Lynch identified it as part of its due diligence in just 10 days. The aftermath of Satyam scam exposure. Raju confessed to crimes including conspiracy, breach of trust, and forgery, and was arrested 2 days later. The shares of the company he was involved with, Satyam, dropped drastically from 554 rupees to 11.5 rupees in 2008. Investigators found numerous fake documents related to land and personnel records, revealing a fraud totaling over 7,000 crore rupees. PricewaterhouseCoopers PwC, the auditing firm, had its license suspended for 2 years after failing to detect the fraud. This scandal caused shares of other companies audited by PwC to drop by 5 to 15%, and the overall market, as represented by the Sensex, fell by 7.3%. To address the situation, the government intervened, appointing a new board to oversee Satyam's sale within 100 days. Tech Mahindra eventually bought the company at a reduced price. Raju and others involved were eventually granted bail, but later sentenced to 7 years in prison. The Satyam scam highlighted the importance of honesty and good practices in the accounting and auditing industry, as such crimes tarnish not only individual companies, but also the reputation of the entire industry and country.